you see a trade notification hit your inbox, your first thought is probably, wait, why are they selling that? Especially when the market is doing well. I'm Shimkus with CGN Advisors, and today I'm sitting down with our Managing Principal of Investments, Mike Grime, to give you a peek into what our team is actually doing with your account on a daily basis. So, Mike, when clients see a trade notification, their first thought is often that we're reacting to the morning news. Is that what's happening, or is there a deeper why?
That's a great question, Cal. So we really try to maintain integrity with our client portfolios. So we're setting our client portfolios up with tolerance bands around different asset classes, asset types, securities, so that we understand that, portfolios are going to drift here and there. And so we do want to trade, though, when portfolios drift outside of tolerance. And so that allows us to naturally keep portfolios from becoming either too risky or too conservative over time.
That makes sense. So really, we're just trying to stay on the tracks that we've already laid out for the portfolio.
That's right.
So does our actual process for trading look different when the market is hitting record highs versus when it feels like a bit of a roller coaster, especially in recent times?
The reasons might feel different, given obviously markets being up or markets being down, but really the process is identical. We're identifying portfolios that have drifted too far outside of where we think that they should be allocated. In a good market, we're going to use that as an opportunity to trim some winners, if you will, and lock in gains. And then when the market's down, we're often going to be potentially, buying the dip, as you might think about it, and rebalancing the portfolio into undervalued areas of the portfolio. It's a systematic way that allows us to kind of buy low and sell high without any kind of emotional guesswork.
So the math stays the same even if the headlines don't. And speaking of the math, another area where we spend a lot of time is on this tax side of things. How does the investment team use these market swings to help a client's tax bill at the end of the year?
Yeah, so in any given year, whether the market's moving in a general up direction or if it's a little bit more volatile or moving down, there are often parts of the portfolio that aren't performing as well as others, providing some level of opportunity for us to trim something at a loss or sell something at a loss, a tax loss. That lets us potentially then set future gains. That's referred to as tax loss harvesting. So it's kind of a way to kind of find a silver lining in a market environment that might be more volatile or trending in a downward direction.
And beyond the trades themselves, I know you're spending a lot of time looking at the actual ingredients that we're using. So what is the investment team doing to vet the funds and managers inside our portfolios? How do we know the parts of the engine that are still the best ones for the job?
Yeah, so on an ongoing basis, we're going through a constant review process, or kind of an auditing process, if you will, of all of the different investments in the portfolio, whether that's an ETF, exchange traded fund, or some other type of fund. It could be individual securities in the portfolio. So we're constantly reviewing the holdings in the portfolio to identify, is there something that would be more tax efficient, something that we could access a similar part of the market at a lower cost? Are the managers themselves sticking with their plan, their strategy? Is this something that maybe they're shifting styles because of the winds of change for the winds aren't behind their back and their style? So if a manager does happen to change their style, that might be an opportunity where we would, let's potentially sell that strategy or that fund from the portfolio and replace it with something different.
Yeah, that makes sense. So basically it's an ongoing audit of every position in the portfolio.
That's correct.
And so my last question here is, when the headlines get loud and things do feel uncertain, how does our team's process help protect the client from that emotional side of investing? The urge to make a move just because they're nervous.
Yeah, it's interesting. This is always fun to look back after the year. We look at these charts called the wall of worry that show everything that's happened throughout the course of a year. And every single year, there's always something to be worried about. Multiple things that catch our attention to cause us to be concerned. That could be anything from inflation or elections or global events like we're seeing today. So our job really is to filter out all of that noise. Over time, what we found is the most damage that happens in client portfolios is when investors react to headlines, when they do something opposite of what their long-term plan would otherwise have them do. And so we really kind of act as a little bit of a circuit breaker, if you will, to help keep their client's portfolio invested in line with their long-term plan. While the world is reacting to today's news, we're looking further down the road, whether that be 3, 5, 10 years down the road. In our discipline, for our clients' portfolios ultimately ends up being one of the client's greatest assets.
All right, Mike, thanks for the insight. It's helpful to remember that while we can't control the markets, we absolutely can control our process. If you ever see a trade in your account and want to know the specific why behind it, please reach out. We're always here to work with you and walk you through it. Thanks for watching.